everyone. Welcome back to Women's Splain. Thanks so much for tuning in. We're trying something a little different with a few of these episodes. I'm making without Sola, even though she's here in our heart and spirit, where I'm creating just kind of a series of solo episodes explaining kind of an area or topic in like the finance, venture capital, investing world. Just as kind of a reminder of who I am, I've spent the last 8 years in finance in New York City, graduated in 2017, spent 2 years in investment banking at a bulge bracket firm, spent the last 5.5 in basically growth equity investing, both at a growth buyout shop and sort of a late stage growth fund as well, mostly in technology and healthcare. I started this podcast because it's such a male dominated field and I felt really alone and just intimidated by the amount of men, honestly, and sort of struggles that we face specifically in finance, which is already such a difficult and intimidating field. And I felt like a lot of times these sort of finance terms and topics really aren't that complicated, but they become really just super opaque and hidden, which is just sort of a nature of the industry where I feel like, finance and investors want to keep a lot of stuff to themselves, mostly from a perspective of information is power. And it's a way to get an edge in a deal, and it's a way to get an edge in negotiations if you understand something that your opponent doesn't. So I want to arm women on both ends of the table and people generally with more information that honestly really isn't that complicated. And that's why I'm doing this. So, let me know how you think. If you have any questions, I'm happy to help you. Happy to explain anything. Please email us, womansplainpod1@gmail.com. DM us, Instagram, TikTok, womansplainpod. I'm here. But today I'm kind of doing a continuation of our last episode, talking about fundraising, talking about diligence, talking about the process, and it's just what would make a founder sort of enter a diligence process. What is diligence? What is due diligence? What is DD? Why do we keep saying it? And what is involved and what are investors asking? And so just kind of take a step back, remind us of the last episode of what would make a founder want money. Basically, the basic idea is a founder of a company needs money from investors in order to get their company to grow for whatever reason. So they basically need outside capital, outside money to pay for stuff so their company can reach to basically like either get more customers, to invest in a product, to hire people, to whatever they need. The company itself needs outside capital to get there. And investors give them money with the idea that this money will be used to hit these goals. That company can then grow, get to a point where the company's worth way more money and their money is turned into more and they get a return on that in some future date. So when founders effectively look for capital, they go through a process of a variety. But that's why investment bankers exist pretty much, is that investment bankers are the liaison usually between companies and investors. They do other stuff, but that's pretty much the main thing. So a lot of times companies will go to an investment bank to help them sell or help them get capital. There are traditionally, until pretty recently, early stage companies didn't use investment banks or brokers. It is now a new trend in the industry that there are more and more investment banks coming out that are representing younger companies, mostly because there are more and more funds, more and more options. It's also extremely difficult and daunting from a company perspective. It can save you time. But you obviously pay the investment banker a fee and it can be expensive too. So it's really just like a balance of what you need and what you want. Investors, like the later stage you are, the more you use investment banks. Earlier stage investors also will reach out to companies directly. They'll do what we call sourcing or origination, in which they basically look for companies wherever they can, whoever they can to invest in. I've done a lot of that in my life, which effectively is like sales, but for trying to get someone to take your money. So basically looking for the type of company that you want from whatever perspective, what fund you are, reaching out to them, cold calling, speaking with them, trying to understand what the company does, and hopefully it's a good fit and eventually investing in them. So it's a very common thing in venture capital and growth for associates are the most junior people. And in investing. There typically are not analysts at private equity or investment firms. Usually you have to do investment banking to go to growth equity or private equity. VC firms are different, but generally associates the most junior person. Associates to reach out and, effectively cold call for companies. Insight is pretty famous for that. Stripes, GA as well. And typically associates are both sourcing. And then once they find a company that they really like, they kind of get some basic information about them. They'll go into what is called diligence. And diligence is basically just finding out more about the company. Literally what it is, that's all it is. And it's a long process and there's different phases of it. But they're mostly divided into what's called pre-LOI or pre-letter of intent and post-LOI or post-letter of intent. Letter of intent and an IOI, which is indication of intent, are pretty much the same thing. This is super confusing. Like, actually, I did not understand what IOI and LOI was for years. But most of the time, an LOI is just also the same thing as a term sheet. It's literally just an initial offering of the money you're going to give the company. So basically, that's all it is. It's also used as a term sheet sometimes. Term sheet is used more in venture capital. LOI and IOI are used more in growth equity and private equity for whatever reason. They all seem like the same damn thing. I think they're honestly, you don't even know the difference. I don't even know the difference, really. IOIs are usually not used as much. An IOI is a step before an LOI, where it's usually used in large investment banking rounds where the investment bank is basically managing a bunch of potential investors. And effectively, the IOI is a little bit less binding than the LOI. So it'll do an indication of intent and then a letter of intent. Now, once you get the key thing about getting to a letter of intent is basically if the company and the investor sign it, you're in what they call a period of exclusivity. Now, the deal has far from closed at this point. All it means is that both of you are interested. You've come to the table and you've signed a document that says, okay, as a company, I cannot entertain other offers. And we are basically in this usually 45 to 60 day period of exclusivity, do more diligence and hopefully close the deal. And so diligence is basically divided into what they call pre and post LOI. And that's what that means. Pre-LOI diligence is, initial. I will say this, different funds have totally different attitudes about pre-LOI diligence. I personally think it's a red flag for all the founders out there, if a fund does no pre-LOI diligence and just hands you a term sheet, I think that's a serious red flag. It basically means they don't take LOIs that seriously, and there are lots of funds that do that, honestly. Effectively hand out LOIs to lots and lots of companies and then don't close deals. Because the answer is that an LOI for an investor is pretty much only a positive thing. I mean, it means, yes, you will spend money on diligence, and diligence will take time, and diligence will take a ton of time from your people who work there, and it will require you usually to pay legal fees and fees for other advisors and diligence, people within that process. But mostly you don't have anything to lose. The company has a lot more to lose in that perspective. They have basically signed a sheet saying that they will be exclusive. They can't entertain other offers. They are spending a lot of time responding to diligence requests, and they haven't gotten any money. And there's also a lot of times that LOI is renegotiated. So this is why my perspective is that if a company doesn't do a lot of diligence, hands you an LOI as a fund, and then you sign it, and then puts you into a 60-day diligence process, the numbers they've given you aren't really based on anything, and they will most likely what they call recut or renegotiate the deal, which, look, I've been through lots of recut processes. My personal opinion is that you should avoid them at all costs. I don't think it's a good thing. There are obviously reasons to do it, because the answer is you don't really get into diligence until you sign exclusivity, and you may find out bad things, or you might find out great things too. But I will say this, I think this is one of the best pieces of advice I've ever heard from an MD, is that time kills all deals. You want to close the deal fast. When you sign that LOI, the clock is ticking, and either person can get cold feet. So my perspective is, as a founder, I would have some time to do diligence before an LOI, and I would negotiate an LOI. It's much better to have a negotiated LOI and then have that be basically similar to what they call the purchase agreement or the closing document. And you want that to be as close as possible. And you want that sort of post LOI diligence process to be as clean as possible. And what do they ask in diligence? Great question. There are usually basically 5 main categories of what an investor looks for in diligence. In pre-LOI, like effectively, it'll usually be like a couple they usually have an intro call with a junior person, will probably be your first step. If they like you, they'll probably elevate it to a call with a senior person. That at that point, also a piece of advice, always make sure after your kind of initial intro or 1 or 2 calls, if they ask for any documents at all, make them sign an NDA. There are funds out there who, try to steal if you're not under an NDA, you can't protect your own IP or property. So just always ask for an NDA if you're going to send them any documentation, is my opinion. It is totally fine for you to give initial sort of financial information on a call. They can't really, if the answer is the investor needs some info to continue. So if they're just asking things like, what's your revenue and your, that's fine. Just like you can give them basic information on that, but I wouldn't go super far without an NDA. If they ask you for any documentation, make sure to sign one. They'll ask you for basic stuff, usually most recent financials, projected financials. They might add, depending how far along your company is, they might ask for, blinded customer lists. They'll ask, like usually 4 or 5 kind of main things. They'll ask for your cap table. If you don't know what that is, that's just the list of all the people who own a percentage of your company. They might ask some other kind of basic diligence questions. They'll usually kind of go through initial diligence with that, do some initial analysis. There'll probably be some follow-up questions. And then the investors on that side, you'll continue to get to know them. You'll learn more about them. They'll learn more about you. And then they'll usually get to a point of what, sort of like valuation. It might take a few weeks. It might take a month. It really depends on what is going on, what they need. And then usually they will go to what's called investment committee, which is basically the committee, like their, internal committee, where like whoever the deal team is, basically usually the 4 people, like 2 junior people, 2 senior people working on your deal will basically present that information to their whole company or to their whole fund for approval, usually with some numbers around it. And then once that's good, they'll basically give you a presented LOI. You'll review that, and we kind of went over that. And if you sign that, you go into post-LOI diligence. Post-LOI diligence, basically there are 5 main general categories that an investor looks at. Basically financial or business diligence. Basically, what does the company do? What problem does it solve? What are their numbers or their previous numbers? Are they growing? How much money are they asking for? How's that money going to be used? How is this money necessary? How is this money going to generate effectively growth and return? That's finance, business diligence, etc. Then they'll usually do customer diligence as well. So look at your customer list, look at things like retention. They'll look at things like type of customer, target. They'll usually ask for customer calls. That'll usually come later in the diligence process, but they will. If you have a lot of customer concentration, let's say you have one big customer, that's a huge percentage of your revenue. That's also something too, etc. They'll also look at market and competitive landscape. So market is the most important thing in VC. So if you are an early stage company and you don't have financials, right? Because the answer is the earlier you are, the less you have to diligence, right? If you are a company that's pre-seed, you have no revenue, you have no customers, really the only thing they have to diligence is like the market, your thesis and your idea. And if you have some sort of product, maybe that, but that's really it. So VC, especially early stage VC, is thesis market driven. So they basically have to believe that, like, let's say that either you're going to be the leader in this small market, the market is huge and growing as a ton of opportunity, and you're going to take a piece of it. You're going to maybe displace a leader. Maybe there's a huge leader in the market that sucks and you're going to replace them. Or generally, I don't know, it's an attractive market in terms of like, maybe it's not a growing market, but it has a lot of green field or white space. It means like there's a lot of space. No one's doing this for some reason. So those are kind of like the main areas. I would say VC trends more toward hot growing opportunity, mostly because that's just sort of the attitude of that type of investor, but you can do any of it. I will say a growth or private equity investor if you are someone who is building a company that is not like a VC hot topic, it might make sense for you not to take VC money. Mostly because I think early stage investors, they don't have a lot to go on. So it's hard for them to invest in something that's in a market that's not trending and growing and hot. And like what it's like, that is sort of, unless they have a really niche thesis or something, you find the right person. If you're creating something that's a little off the cuff and maybe not as like sexy, maybe it makes sense for you to wait a little and take a growth round later, which I feel like a lot of growth investors love bootstrap companies. So, you know, like an example of this is a company that I, you know, invested in a few years ago. And it was a bootstrapped family-owned business that did basically software for loan originators, which sounds so boring. And in all honesty, is certainly not the sexiest area. But look, they grew it to a point that was in that like 9 to 10 million ARR range. They were super profitable. They did it without outside capital. And then they got a great valuation from a growth investor. But I think they would not have gotten early stage money because it sound like their customer base is like random lenders and maybe banks. It's like, it's difficult. Lending can kind of be risky. It kind of takes capital, even though they weren't actually, we don't have to get into it, even though they weren't really a lender, it, you know, because it's sort of in this off the beaten path market, it might not be the best fit for VC. So depending on who you're targeting. And then, so market, competitive landscape, industry sort of within that, they'll do a lot of things called GLG calls, basically where they have, like, there's all these services set up for private equity investors, literally. And they basically get set up with experts in the industry to learn more about the industry. And then they'll obviously do legal as well. And technology and product. So if you're a tech company or product company, they'll do also usually hire experts to basically diligence your product. And then they'll also do accounting diligence. They might not do, if you don't have any revenue, they won't. But if you, which effectively what they call a QOE, or quality of earnings. And all that does is basically confirm that the numbers you gave us are real, pretty much. It's very common for LOIs to say things like, you know, this is based on, because at that point, obviously, we've just accepted numbers that you've given us. So we basically have been receiving just like an Excel spreadsheet with your revenue in it. And there's like, we just have to trust what it says on base value. It would be irresponsible for an investor not to effectively hire accountants to make sure it's real, to kind of go through your books to make sure you're not defrauding us. So it's very common for an LOI to say, you know, this valuation is based upon, you know, a successful QOE, etc. Don't be freaked out by that. And that's sort of the process. And so it's 45 to 60 days is pretty normal generally throughout the industry. Buyouts a little longer. If there's more stuff, maybe you'll get to, you know, 75 or something. Growth usually tries to keep it at 45. That's basically what it is. And I will say, look, these are things that, from my perspective, diligence is super annoying for founders. They hate it. They're operators. They're not investors. It takes a lot of time away from operating the company when usually your company is in like a phase in which like you need capital. So you're probably understaffed. You're trying to continue to grow. You're trying to continue to function. You're trying not to screw up. So you're like, this deal doesn't go away. And the investors are asking you 5 kajillion questions. And it's super annoying. And I get it. I will say, you know, as a founder, I think you just need to be as patient as possible. I would, if I were you, even if you didn't hire an investment bank when you were looking at deals, potentially consider hiring a broker or investment bank at that point, because they will take care of all this diligence stuff for you. And especially if you're a company that's like, if you don't have a CFO, which is very common for growth stage companies, like they don't have a CFO, the CEO is doing it all, right? And they're like, we don't have an Excel model. We don't have this information. We don't have all these things. Like, this will take a huge lift for us to put in a nice format for investors to look at. I would look at maybe, like, there are so many now, like small little brokers and advisors and investment banks that will work with earlier stage companies. And even though it's a fee, that fee is actually typically paid, like that fee is paid by the private equity firm in the long run. So they end up closing the deal. So because it's a transaction cost. So it's usually. So it really isn't like a big hurt to you, especially if you're at a point where you're already close to an LOI. The only time it's really risky to hire an investment bank in terms of fee, et cetera, is like if you end up not getting a deal done, that can hurt you. But if you're already at a point where you're going to get a deal done, it's pretty much a win for you. So I would think about that because it's stressful. But my general advice with diligence is just be as honest as possible. Be as honest as possible from the beginning. Do not try to hide things. Do not show any sort of crazy projections that are unrealistic without backup. I think for investors, that's their biggest, like, honestly, like, red flag, like, shut down, whatever, is if they get projections from management that are completely insane. Like, I'm sorry, you're like, okay, like you're gonna be $1 billion company in 2 years. Like, just don't tell them that, honestly, or just say it in a better way or show just more realistic builds, whatever. They would much rather have like an honest founder that shows like, yes, aggressive growth, but one that doesn't just sound completely out of this world. So I'd say from my perspective, it's probably and that can also scare away really good investors that are actually more trustworthy, and ones that maybe do more diligence. So I say that's from my perspective probably the biggest set of advice. And I will say this, definitely get a lawyer you trust. I think legal diligence goes at the end, and there are so many legal documents, there's so many details, especially if you're taking a big check and what that is. Get a lawyer you trust, get a lawyer who will fight for you. I would recommend getting one that the private equity firm does not recommend. Mostly because, like, just get a separate independent lawyer. That would be my recommendation. And in order to kind of get through the tail end of diligence, and be patient. And also through this process for you should diligence that private equity firm too, whoever you're taking money from. Ask for references from founders. Ask for references from founders that honestly like may have left under good or bad circumstances. Ask for references from people they've worked with or people that have left, and have those conversations that are real. And even do like back channel references if you can. Like if you know of a founder that worked with them and maybe left, try to reach out, because the answer is you never know who people really are until they're on your board, and you want to be with people on your board that are supportive and you see eye to eye with. And even if you do end up leaving or you do end up exiting, you want to ideally like be partners and have a good experience. So I'll just say diligence is for you too, as well as for them. So yeah, I think that wraps up today on diligence. If you have any questions, please reach out to us, womansplainpod1@gmail.com, DM us, and thanks so much for listening.